All right, so now we're going to kind of jump into the rest of things here. Um, so when we're talking about property, plant, and equipment, and we sort of had previously discussed the cost is not just the price, obviously, there's other things like shipping, installation, testing, legal fees, all those different things. Obviously, the key here, though, is that those costs are inherent to the long-term use of the equipment. So in other words, if for me to actually use a piece of equipment, I have to be able to ship it, install it. It's got to get ready to use. And so those are going to be capitalized. But things sort of after that, like training or maintenance, those are going to be expensed. And so that's really the distinction between when do we capitalize something versus when do we expense something related to something like a piece of equipment. We are going to really focus on asset retirement obligations or sometimes asset retirement liabilities. And so really the rest of this lecture is focused really on how do we account for those. And so what is an asset retirement obligation? There are really four key aspects. One is the scope. And so AROs, they arise basically when you have a legal obligation at the retirement of a tangible asset. So the key is, like let's say mineral deposit is really the most common one. So let's say that I've got, I'm oil and gas and I'm drilling somewhere. Part of my agreement might be that I've got to like, restore that land or otherwise return that land to the condition that it was before I showed up. There's gonna be costs to doing that. And so essentially what this is saying is that cost, we're gonna figure out how we measure that, but that cost is gonna be included in the cost of that asset. So the mineral deposit wouldn't just be the cost of the acquisition or the development and all those other costs that go into it, but it also be the cost of that restoration at the end, right? And so that's what an ARO is. But again, it's a legal obligation to do this. As far as when it gets recognized, many times it's going to be at inception. So in other words, hey, I know I've got to do this. I have an estimate. Let's throw it out there. But it also could technically arise over time. In other words, you could be going about doing some sort of extraction and then cause damage or otherwise do something that was maybe a little bit unexpected or something like that where all of a sudden now, oh my gosh, I've got this extra cost. Well, we don't expense that. Instead, we roll it up into the cost of the asset itself, and we sort of treat it the way we're going to kind of walk you through it. But there is a process for sort of allocating that cost over time versus expensing it immediately. So again, it can happen immediately or at inception, or it can happen over time. Measurement, so you use the fair value of it from the period that it's incurred. Now, the key when we talk about fair value is a lot of time the costs of that reclamation or restoration is not going to be paid for quite some time. And so we're going to kind of see that a key idea of when you measure this is present value. Because the reality is there's two things going on. One is you do need to estimate the expected cash flows because we don't always know exactly what it's going to cost. And then the second thing is usually it's in the future. So you've got to somehow discount those cash flows. So not only have an unknown amount, but you have an amount that's going to be paid into the future. So you really have two things here. You have some sort of expectation measurement, and then you have some sort of application of the time value of money. And so that is how we account for this ARO. So just to be clear, the cost of that is going to get rolled up into the cost of the asset. And then there's also what we're going to see is there's going to be a liability. And so really we're going to focus here is how do we handle that liability? Because the asset's just going to be treated with the asset. So when we figure out land, building equipment, all those things, that's going to be part of that chapter or that future. But really, the what's unique maybe to right here is, well, we've got a liability sitting there. How do we handle that liability? So we're going to kind of walk through that. All right, so let's walk through an example. A 49 company paid $2,300,000 for an old deposit in Texas. They had exploration costs of 925,000, development costs of 1,240,000. We're keeping it simple, just saying they expended that immediately. And then the company must purchase rigging equipment that costs 870,000. So in other words, I'm a company, I paid all of this up front and I purchased the rigging equipment up front. So I might be paying a third party to do the work, like subcontracting it out. But essentially, I'm paying this all immediately. And then in addition to that, they are required to restore the land at the end. So Ken, this is back to that asset retirement obligation. And they have these different outcomes. Obviously, it wouldn't always look this way, but there's basically, hey, things didn't go that bad, so I'm gonna have to pay 450. Then sort of, this is really the majority of the time. I'm gonna pay 520. And then finally, okay, things really went bad, and I've got to do a lot of work. And so, but again, we have different probabilities. And so what we want then is what are the initial journal entries for this purchase of the deposit? And we're also going to walk through how do we handle that asset retirement obligation after we initially record it. We're going to use a risk-free, credit adjusted risk-free rate of 7.5%. Of course, anytime we use time value of money, we need some sort of discount rate, and that's what we're going to use. The first thing we're going to do is figure out, okay, what is the present value of that restoration cost? And the first step is we need to calculate an expected value. And so hopefully you've seen this before, but we're doing a weighted average calculation. If you remember in RevRec, we did a variable consideration problem where, oh, I have a bonus and my bonus might be 10,000, 20,000, 30,000. We had all these different outcomes. And we had to do some sort of weighted average of that. Same thing here. We're doing a weighted average. So again, 40% probability that you have 450,000, 50% 520, and then 10% 925 for a weighted average of 532, 500. But again, that amount is expected to be paid at some point in the future. And so since at some point in the future, we now have to discount it back. And so hopefully, again, TVM is something that you're familiar with. And we're just using sort of the way your financial calculator would be set up. And of course, that cost is going to be paid in 4 years. We're going to do an annual discount rate. So we're going to discount everything, once a year. There's no recurring payment. There's just the lump sum expected payment at the end, knowing that it's not going to be exactly this amount, but we're using that expected amount. So we do the calculation, we get 398, 726. I think I think this might be a typo. I think some people said that there's 736. I'm just sticking with this number, even though it might be a little bit off. I apologize. I think at the very tail end it does create an issue of rounding. But in order to get this video out there sooner, I just wanted to kind of do this, even though I know that number's wrong. All right, so how do we handle this? So first of all, of course, that initial journal entry of recording the fact that we purchased this oil deposit. And so remember the cost, it's not just the purchase price, it's not just the exploration cost, it's not just the development cost, it's also the restoration cost. Notice that I ignored the rigging equipment. And the reason why I do that is because the rigging equipment would be handled separately. So the equipment would be over here, and then the oil deposit would be over here. We treat them completely separately. All right, so then when we talk about the restoration cost, the key there though is we're going to bring that on at the present value. So the restoration cost is brought on at the present value. And so that present value is 398, 726. The other amounts are given for a total cost of $4,863,726. So that's the amount that we assign to the oil deposit, noting that, of course, most of that is paid in cash. That's the 2.3, the 1.24, and the 925. And the remaining amount goes into this asset retirement liability account. And again, our focus then is, okay, what do we do, at least in this chapter or this lecture, what do we do with this ARO or ARL after this initial transaction, right? So that's really what the rest of this is going to be about. All right, so again, we have that risk-free rate, and this is where we have to do amortization. So the way we handle the ARO is through amortization. So we're going to record basically the accretion is what the term they use. So we're going to use the accretion of the ARO over time using an amortization schedule. And so hopefully this isn't completely new to you. If it is, the first line I'll kind of walk through, but you have this ARO balance. And then after 1 year, basically what's ended up happening is that ARO is going to accrete continuously throughout the life of that liability, but we're only going to record it periodically. So we're going to just do it once a year to keep it simple. And so after the first year, the accretion expense is the initial balance times 7.5%. That's where this 29,905 came from. Of course, there's no payment towards this obligation. And so that the obligation increases for the amount of that accretion expense. So if you kind of think about that obligation is going to grow over time, the name of that growth in the obligation is accretion expense. Most of the time we've seen it as interest expense, but this is different because this isn't like a note or debt or anything like that, but it is a liability. And so that accretion expense then, accrues to the ARO balance. And so now we have a higher balance. And so, of course, now when we apply 7.5% to the second year, it's going to get higher. And then the third year is going to get higher than that. And again, noting that at the end, there's some rounding because, again, I believe this was a little bit off. And so it kind of creates a little bit of an issue trickle down. So I apologize for that. But hopefully the numbers just kind of make sense, even though I know it's a little bit off. All right, so then what do we do? After 1 year, essentially what we have is, on December 31st, we have to record this. Again, the amortization process has been continuous, but we're recording it periodically. And so now we need to make that periodic. And if you remember this term from intermediate one, but it's we're going to make the periodic adjustment, right? So we're adjusting this account because we're going to be creating financial statements and things like that. And so, if you're doing financial statements every month, you might end up making the adjustment sort of proportionately throughout the year, or every quarter. It might be, proportionately every quarter, but we're keeping it simple. We're doing it just once per year. So the key is what's happening to this ARO balance, right? So it's increasing, and it's a liability. So we know that liabilities increase with the credit. And so that amount is a credit to the asset retirement liability. And then, of course, we're going to debit the accretion expense to offset that. And so this goes on our income statement. It gets close to retained earnings. This is just an increase to that permanent liability account. And of course, we would just do that every single year. So, right, so same accounts, just different amount every single year until we come to the very end on 12/31/2028. Now we're at the end of the life. And we're at the end of our 4 years. We've finished doing what we're going to do. And now we've got to take it from there, which is to actually reclaim or restore the land. Now, of course, we estimated or we expected it to be 532,500. If you think about what happened to this balance over time, it grew to that expected amount. So that at the end of 4 years, the balance in that account is our expected amount of 532,500. We know that that's not one of our three distinct outcomes, which means then there's going to be a difference between what we expected and what we actually paid. And so, again, sometimes it might be helpful to pause here for a second, but I end up paying 520. And so I want you to conceptualize, just, again, maybe pause or whatever, but conceptualize, is that a good thing or a bad thing? So on paper, I'm saying, well, I expect to pay 532,500. I actually only paid 520. And so there's got to be, whenever there's a difference there, there needs to be some sort of reconciliation. And in this context, that means we're going to record a gain or a loss. And so the question is this going to be a gain or a loss? Again, pause it if you want to. But the answer is this is going to end up being a gain because this is a good thing, right? So I thought I was going to pay 532. I only paid 520. That sounds like a good thing. That should be a gain. And let's figure out if that actually plays out. We'll just kind of use the journal entries to get us there. The first thing we got to do is take the asset retirement liability off of our books, right? We got to take that off of our books at 532,500. And of course, we paid 520. And that means we're in need of a credit. This ends up being kind of a plug. And so we need to plug that $12,500 difference. And that ends up being a gain on settlement. If it had gone the other direction, let's say we had to pay 932 and some change, then notice the credit would be a lot more and we'd be in need of a debit. And that debit would be a loss on settlement. So again, your intuition should say, well, if I pay less than I expect, that's a gain. If I pay more than I expect, then that's a loss. And the journal entry plays that out. And so that is the ARO example. The next lecture is going to go over intangible assets, but hopefully this is helpful.